Capital structure describes how a business uses various funding sources to support its operation and expansion. These sources can be debt, equity, and even hybrid securities. Dividend policy, known as the method a business uses to determine the quantity, schedule, and kind of dividends it will pay to its shareholders. The connection between dividend policy and capital structure is lower dividend payment may be preferred by companies with higher debt levels in order to preserve cash for interest payment and debt servicing. Second, companies with strong cash flow and consistent profitability allow business to retain balanced leverage and choose to pay out larger dividends.
Now we are going to talk about the advantages and disadvantages of capital structure. So the advantages of the capital structure is first is tax benefits. Debt financing provides tax shields as interest expenses are tax deductible, reducing overall taxable income. The second one is lower cost of capital. Debt financing is often cheaper than equity due to lower required returns from lenders compared to shareholders. Last one is control retention. Issuing debt instead of equity helps maintain control of the company as equity financing dilutes ownership. Next, we are going to talk about the disadvantages of the capital structure. So the first one is fixed obligations. Debt requires fixed interest and principal repayments, which can strain finances during downturns. The second one is financial risk. High levels of debt increase financial risk, especially if the company faces cash flow issues. And the last one of the disadvantages of the capital structure is restrictive covenants. Debt agreements may impose covenants limiting managerial flexibility. Next, we are going to talk about the advantages and disadvantages of dividend policy. Advantages of dividend policy is first attracting the investors. Income-oriented investors are drawn to companies with consistent dividend payouts. The second one is signaling effect. Stable or increasing dividends signal financial health, potentially attracting more investors. Last one is shareholder satisfaction. Regular dividends provide income to shareholders, increasing investor confidence and satisfaction. Then we are going to talk about the disadvantages of dividend policy. The first one is irregular cash flow pressure. Companies may feel pressured to maintain dividends even during financial hardships, potentially straining liquidity. Second one, inefficiency in taxation. Dividends are subject to double taxation, which is corporate income and personal taxes, reducing the net income for shareholders. And last one, reduced retained earnings. Paying dividends limits the funds available for reinvestment and growth opportunities.
Dutch Lady Milk Industry is Malaysia's leading dairy company, found in 1963 and the first dairy firm to list on the Bursa Malaysia, formerly known as Kuala Lumpur Stock Exchange. The relationship between capital structure and dividend policy of Dutch Lady Milk Industries Berhad is low debt levels and high dividend payout, which Dutch Lady can allocate greater earnings to dividends without compromising its financial stability because of its comparatively low reliance on debt. The business consistently provides returns to shareholders and maintains its reputation as a reliable brand in Malaysia's dairy sector because of its prudent financial management. And Dutch Lady exhibits a significant dedication to long-term success by striking a balance between growth, sustainability, and shareholder value.
Next, for analysis capital structure, we look at debt to equity ratio. For 2022, it has 1.93, and for 2023, it has 1.17. This shows that debt to equity 2022 is better than 2023. This increase indicates that Dutch Lady Milk Industries slightly increased its reliance on debt financing relative to equity in 2023 compared to 2022. Then we look at time interest earned. For 2022, it has 15.24, and for 2023, it has 22.08. This shows that time interest earned for 2023 is better than 2022. This indicates that Dutch ready-mix industries became more capable of covering its interest payments in 2023 compared to 2022.
Dutch Lady dividend policy can be analyzed by dividend payout ratio, which dividend paid divide net income. And from dividend payout ratio, we can calculate retention ratio by 1 minus dividend payout ratio. As we can see, Dutch Lady paid off constant dividend on 2 years, which 32 million ringgit on 2022 and 2023 respectively. This constitutes 44.2% of the company's net profit attributable to shareholders of 72.4 million ringgit in 2023, and Dutch Lady compute a high retention ratio, which 55.8% show that a sizable amount of the company's profit are being reinvested in the company. On 2022, 69.16% of the company's net profit attributable to shareholders of 46.3 million ringgit, and low retention ratio, which 30.84% show that company reinvests less than half of the net profit back into the company.
Okay, so here's how each financing option impacts the company. Debt financing is tax deductible and retains control but risks over leveraging. Internal financing avoids interest payments but can limit the ability to fund large projects. And last, equity financing provides flexibility and reduces repayment pressures but dilutes ownership and it's costlier. So that is recommendations for capital structure and dividend policy. To ensure financial flexibility and growth, we recommend a debt to equity ratio of 30% to 40% debt and 60% to 70% equity. This is because debt should fund high return projects like facility upgrades and market expansion. That is, equity should be reserved for transformative projects like R&D and acquisitions. This will balance approach, minimize risk while maintaining flexibility. Okay, so for dividends, we propose a payout ratio of 50% to 70% of net income to reward shareholders while retaining funds for reinvestment. A progressive dividend policy linked to profit growth will enhance shareholder confidence. And also, in the case of excess cash, a share buyback program can boost earnings per share and reflect financial strength.
So next is the research question. So first question is, how do companies make decisions regarding their capital structure and dividend policy, and what current practices are they employing to optimize their financial performance? Company makes decisions about their capital structure based on several factors: cost of capital, risk tolerance and stability, and also regulatory and tax consideration. For the current practices, Dutch Lady likely employs a mix of debt and equity, possibly leaning towards equity due to its stable market position and lower risk. It would typically rely on retained earnings or investment profits and debt financing for short-term needs or expansion, aligning with overall strategy. Next is company makes decisions about their dividend policy based on several factors such as shareholders' expectation, cash flow considerations, and parent company's influence. The current practices is Dutch Lady dividend policy would likely focus on providing regular dividends to maintain shareholder confidence while keeping a portion of profit for reinvestment and growth. Historically, companies like Dutch Lady have had a stable or progressive dividend policy to appeal to long-term investors, reflecting consistent earnings and strong market position. So question 2 is, can you explain the factors that influence a company's choice of capital structure and how have recent economic conditions affected this decision? Provide examples of companies that have recently adjusted their capital structure in response to changing market conditions. So factors that influence Dutch Lady choice of capital structure is cost of debt,
versus equity, business risk and stability, and also tax consideration. The impact of recent economic conditions is rising interest rates and debt financing, inflationary pressures, and economic uncertainty. For the example of recent capital structure adjustment in response to market conditions is liquidity focus post-pandemic. In the wake of the pandemic, the city may have adjusted its capital structure to reduce reliance on debt and focus on internal cash flow. Second is expansion into plant-based products. The city has diversified its product offerings, including venturing into plant-based dairy alternatives, which might require additional capital.
Question 3. How do companies decide on their dividend policies and what factors do they consider when determining how much to pay out shareholders? Can you provide example of companies that have recently changed their dividend policies and what drove these decisions? So, company establish their dividend policies by evaluating several key factors to balance rewarding shareholders with retaining earnings for future growth. Their primary considerations include, so the first one is shareholders' preference, where companies consider investor preference. Income-focused shareholders may favor regular dividends, while others might prefer investment for capital gains. The second one is tax considerations. Tax policies influencing dividend taxation can impact the attractiveness of dividends to shareholders. The third one is profitability. For profitability is when sustainable profits enable consistent dividend payments. Companies with stable earnings are more likely to distribute regular dividends. Last one is cash flow stability. Cash flow stability is when reliable cash flow ensures the company can meet dividend commitments without compromising operations. So the example for companies that change their dividend policies and what drove these decisions is the Lady Milk Industry Berhad. In 2023, the Lady Milk Industry Berhad maintained a consistent dividend payout, declaring 2 interim dividends of 25 cents per share each, totaling 50 cents per share for the year. This approach aligned with their 2022 dividends payments, reflecting a stable dividend policy. This balance reflected several factors. First, market conditions. Second one is investment in new manufacturing facilities. And last one is financial performance. By balancing shareholders' return with strategic investment and prudent financial management, the Lady Milk Industry Berhad dividend policy in 2023 exemplified a comprehensive approach to sustaining growth while meeting shareholders' expectations. Question 4. How do companies balance their need for growth and investment with their obligation to pay dividends to shareholders? Can you provide examples of companies that have successfully managed this balance and how they structure their capital and dividend policies to achieve their goals? So first, how do companies balance their need for growth and investment with their obligation to pay dividends to shareholders? So there are some strategic approaches, and which is the first one is retention versus distribution of earnings, where companies allocate a portion of profits to reinvestment in business operations, retain earnings, and another portion to dividends. The second one is implementing flexible dividend policies. Companies may adopt flexible dividend policies such as progressive dividends and variable dividends. Progressive dividend is where gradual increases in dividends as profitability grows, such as Microsoft. Variable dividend is when adjusting dividends based on annual performance, allowing companies to prioritize investment during weaker financial periods. The third one is debt financing for growth. Companies may use debt financing for growth projects instead of relying entirely on retained earnings. This allows them to continue paying dividends while investing in expansion. And last one is strategic use of share buybacks. Share buybacks are an alternative to dividend payments. They return value to shareholders while allowing companies to retain cash for growth initiatives. Example of companies that managing the balance is first the Shady Milk Industry Berhad. How they have structured their capital and dividend policy to achieve their goals. So there are three factors, which is first capital structure. The Shady Milk Industry Berhad reinvested significant funds into developing new manufacturing facilities while maintaining steady dividends. Second one, dividend policy. Despite the market challenges like rising milk prices and inflation, the Shady Milk Industry Berhad maintained a dividend payout of 50 cents per share in 2023. Growth investments. The company balanced shareholders' reward with strategic investment, ensuring long-term profitability. The second company is Microsoft Corporations. How they decide is first, which is based on capital structure. Microsoft generates substantial free cash flow, enabling it to fund growth initiatives like cloud computing and artificial intelligence. Second one is dividend policy. It adopts a progressive dividend approach, increasing payouts annually while still prioritizing reinvestment.